with our firm PD Tax, and she's going to be taking you through some of the finer points of Sdlt and the reliefs. A little bit about ourselves. What we do is we aim to kind of break down tax into ways in which our clients can understand. And the main focus of what we do is really to ensure that individuals and businesses are paying their tax correctly, but also no more tax than they really ought to, so taking full advantages of reliefs and good tax planning. So yeah, a few examples there about what the kind of advice that we provide. We also do share valuations. Some of you might not be aware that we do assist there. But yeah, if there's anything, if it's technical and it's tax, we can probably help you if it's in relation to the UK. A little bit of general housekeeping before I pass you over to my colleague Laura Hayes. We're going to try and finish for 10 AM sharp. Your mics are going to be disabled all the way through the webinar. So if you do have any questions, please pop them into our Q&A box as the webinar progresses. And then at the end, my colleague Laura Brennan, who's also on the call today, we'll be able to ask those at the end for me and Laura Hayes. But if we don't have time to answer them, there is also a breakout session after the webinar, so you can stick around and we'll unmute your mics and you can ask some questions then. And otherwise, we'll look to follow up with you after the meeting. And then just a final disclaimer there: this webinar is only for general information purposes and isn't intended to constitute actual advice. So if you do need advice, it's worthwhile seeking a professional for that, such as ourselves. So I'll pass you now over to Laura, who's going to take you through some of the principles of Sdlt and some of the interesting reliefs.
Thank you. So we're going to start with the main principles of Sdlt. So Sdlt is payable on the purchase or transfer of land in England and Northern Ireland above a certain threshold. So the purchaser is the one who is liable to make a land transaction return to HMRC within 14 days of the effective date of the transaction, which is usually the completion date. And any tax payable is also due by that date as well. The Sdlt rates depend on whether the property is residential or non-residential, and also whether it's freehold or leasehold. So this slide gives an overview of the Sdlt rates for residential property and then also for non-residential property and mixed-use property, based on the consideration given. So there are a few points to note in relation to these rates. So in relation to residential property, firstly, there are different rates for first-time buyers purchasing an only or main residence. And secondly, you'll see on the left-hand side of that table for residential property that sometimes different rates are applicable. I'll talk about these on the next slide. And then in relation to non-residential and mixed-use property, it should be noted that these rates can also apply to 6 or more residential properties bought in a single transaction. So, as you've noted in the previous slide, in relation to residential property, sometimes the basic rates of Sdlt can be increased by 3% for each consideration bracket. So this 3% surcharge is added where there's a purchase of additional residential property if the relevant conditions are met. So for individuals, I've put those in the box on the side there, and briefly they are where the person's interest is £40,000 or more, the property is not subject to a lease that has more than 21 years to run, the person owns another house with an interest of £40,000 or more, and the person is not replacing their only or main residence. Companies are usually liable to the 3% increase on all purchases of residential properties if conditions 1 and 2 in that box on the right are met. However, there may be an exception in some circumstances for house building companies. And there are also some other exceptions to the 3% surcharge to be aware of. So they relate to where there's a sale of a main residence, where a new one is purchased to replace that one within 3 years. Also on divorce, where one party still occupies the old property. Mixed-use properties, where a property contains a subsidiary dwelling and where there's a purchase of a main residence and certain other conditions are met. But this is also something that I'm going to touch on later on. There we go, next slide. So a 2% surcharge may also apply to non-UK residents who are purchasing a UK residential property. And this was introduced from the 1st of April 2021, and it applies to individuals, companies, partnerships and trusts, and if the property conditions are met. So I've put those in a box down there in the corner, so you can see those there in relation to freehold and leasehold properties. There are special rules for determining non-UK residents or residents for SDLT purposes, and they are different to the normal statutory residence test. So if you're considering this, it's worth looking into those. And it's also important to note that a refund of the 2% surcharge may be possible, or you may be able to claim that if the person becomes UK resident after the purchase. So as we've just seen, there's a 3% surcharge on the purchase of additional residential property. So I'm now going to talk about a relief called multiple dwellings relief, which may be applicable where more than one dwelling is purchased in a single transaction. So I've put the references for where you would be able to find the different definition of a dwelling in that star in the corner. But in summary, a dwelling is defined in the legislation as a building or part of a building which is used or suitable for use as a single dwelling or in the process of being constructed for use as such. HMRC guidance in relation to this notes the importance of independent access and facilities such as sleeping and living areas and bathrooms and kitchens to establish whether there is a dwelling there in separate buildings. So where you've established that there is that more than one dwelling, multiple dwellings relief allows the calculation of SDLT based on the average value of the total number of dwellings, which can produce a significant tax saving. So with multiple dwellings relief, you would normally be dealing with properties where the 3% surcharge is applicable because of the nature of the properties. However, in a case where the purchase is of a main residence and there are 2 dwellings and the relevant conditions are met so that one of the dwellings is subsidiary to the other dwelling, the purchase can be treated as a single transaction and the 3% surcharge would not be applicable. So this might be you might come across this where somebody's purchasing a main residence and then there's a main property and then there might be a cottage or an annex, and the cottage or the annex meets the conditions to be a subsidiary dwelling to the main dwelling. And then in addition to the normal SDLT rates applying in that circumstance, multiple dwellings relief can also be claimed, and that has been confirmed by HMRC. So this can result in a significant tax saving. And we've seen this coming up quite frequently recently, so it's a very valuable point to be aware of. Okay, so now it's time for our poll. So the question today is, have you ever considered multiple dwellings relief on the sale of a main property with a subsidiary dwelling? So Ryan, could you please launch the poll for us? And then if you could, and we'd be very grateful if you could put in your answers to this question.
That launched now, so I think has that been launched? Yeah. That should be launched. So yeah, please cast your votes, everybody. I'll give you 30 seconds to pop your answers in. A few more seconds for you to vote. Okay, I think that's what we're getting. So actually the majority of you haven't come across that situation before, which is interesting because we are starting to see it more and more. And I think as well, sort of during the last couple of years, there's been a lot more cases of subsidiary dwellings being built on properties. So it's something, it is really an important point to think about because it's quite material SDLT savings to be had, which I think was highlighted. Oh, sorry. I've shared the results now with you all. Okay, so I'm just going to move on now to some of to my section. Thank you very much for that, Laura. And I want to focus on mainly on property business and corporations and the Sdlt around that. So for those of you that aren't aware, a property business incorporation would be where an individual or individuals have a personally owned property portfolio and they want to transfer that into a company. There's various reasons for doing that. It's very tax effective planning. The company gets tax deductions for mortgage interest and finance costs, so where those properties are mortgaged, it's much more tax effective for them to be in a company. But the company also allows flexibility on remuneration and also allows us to leave more, if we're looking to reinvest the funds into acquiring further properties, the company is much better than that because we're not going to suffer higher or additional tax rates, we're just going to suffer corporation tax, and then we've got more money to reinvest. It's also a very good IST planning tool as well. So it's very good and effective planning, but when we are thinking about transferring properties, we have to think about capital gains tax and stamp duty land tax. Well, capital gains tax is outside the scope of this webinar, but suffice to say that it is possible to get relief for capital gains tax on a property incorporation. But Sdlt is a bit more complex. So we're transferring the properties from the individual to the company. And the way that that's structured is that there's no cash being transferred. Instead, the individual would get new shares in the company in consideration for their the transfer of the properties. Now, in spite of the fact that there's no cash, because the individual and the company are linked, are connected, that transfer would be at market value for stamp duty land tax. So if those properties are worth, let's say, £5 million, we're looking at a transfer of £5 million for Sdlt. In addition to that, because the properties are going from the same buyer to the same seller, from the same seller to the same buyer, those transactions are linked. So instead of us having, let's say, 10 Sdlt computations for each property, we would have to assess the Sdlt as a single computation, as if it was a single property for the total deemed consideration. So that can be quite bad for Sdlt because we're getting a lot of Sdlt at much higher rates on the transfer. So despite the fact that an incorporation is very good tax planning, there could be a big upfront cost from an Sdlt point. So what can we do in order to mitigate that? Well, Laura's touched upon a couple of these already. If we just have a single individual with a property portfolio, so they own those properties outright, well, we might look at multiple dwellings relief. So we'd look at assessing the Sdlt on the average value where there's residential properties involved in lots of dwellings. And also if there's 6 or more dwellings, we could also look at applying the non-residential rates to the total value of the transaction to see if that gives us a better result than multiple dwellings relief. But these calculations can be complex, and especially if you've got commercial and if you've got residential and non-residential property being transferred, there's lots of they need to apportion the different deemed consideration and determine which rates apply to which parts. So it can be quite a complex calculation, and there also can be, even with reliefs, quite a material amount of stamp duty land tax that is paid. Noted there on that slide that where it's just an individual, and by an individual I mean a single property owner, transferring to a company, there's stamp duty land tax to pay, but we might be able to get some relief. However, if we have a partnership or an LLP, there's something called the sum of lower proportions relief, and that relief can in effect mitigate that stamp duty land tax completely, but it only applies to partnerships and LLPs. So we've got this property incorporation, we're managing to get around it, it's capital gains tax. And if we've got a partnership, an existing partnership or LLP, we can also make that transfer without stamp duty land tax as well. So it's very, very effective tax planning. And those are the things you should be keeping an eye out for if you've got those property partnership businesses. Then there could be some very good tax planning here to transfer it into a company. But a couple of things to think about if we've got an individual. If we've got an individual, there's going to be an Sdlt bill. However, if that individual is in a civil partnership or is married, we might want to look at establishing a partnership by transferring a portion of those properties from their ownership into joint ownership with their spouse or civil partner. That can be done free of capital gains tax. And also, if we only transfer a small amount, we can potentially do it for a very small amount of Sdlt. And then once we do that, if we establish a partnership agreement and we might want to file a partnership return after a material amount, well, enough time has passed, we could then incorporate. And then we could take advantage of the sum of lower proportions relief. And it's worth noting that when we've dealt with this, if you've got property portfolios worth in the millions. The Sdlt payable can be in the hundreds of thousands. So it really is worthwhile kind of thinking through this kind of planning. But yeah, a point to note, you couldn't just establish a partnership and then incorporate the next day. I think HMRC are going to see right through that. So it's important to kind of do this in the right way. And another point to think about is whether there's a partnership already in existence. We had a case about 3 or 4 years ago where there was a married couple and they had a jointly owned property portfolio, but they'd always filed individual tax returns and never a partnership one. Well, you know, a partnership, whilst it should be evidence where it can, the rules that in determining whether there is a partnership is based on the facts, and we were able to establish in that situation that in fact there was a partnership and there had always been a partnership in place, and so we were able to claim the relief in that instance for those individuals, despite the fact that they didn't have a partnership agreement or had filed a partnership return before. But it's very valuable. It's very good tax planning to incorporate your property business, and it's also there's very valuable relief available if it's structured in the right way. So it's something to keep an eye out for if you do deal with landlords and people letting property. I'm going to move on now to another section, which is stamp duty land tax on leases, where a lease, where we have a lease, if it's an existing lease, and that lease is assigned, so it's transferred to someone. Say you have a 99-year lease, and after 10 years you choose to sell it. Well, the stamp duty land tax on that lease will be assessed in much the same way as it would with a freehold property, and you would just assess it on the consideration involved. So it's not too complex there where we've got an existing lease. The story's a little bit different though, where we have the grant of a new lease, so we're creating a lease. And in that event, we need to think about both the lease premium, which would be the amount payable up front for the acquisition of the lease, and also the rent payable over the life of the lease. Now, for the lease premium, again, it's not too difficult a story because stamp duty land tax is chargeable in the same way as if it were normal consideration on say a freehold property. So whatever is payable, that consideration that's payable up front, is assessable in the same way as if it were acquiring a freehold. Though probably worth noting that different rates apply for residential and non-residential property. The complexity comes with where we've got rent payable, because the rent payable is also subject to stamp duty land tax, and it's subject, the amount subject to stamp duty land tax is the net present value of the rent over the entire life of the lease, which even as a tax consultant I could say is a very complex calculation to do. And the reason that it's done like that is because potentially what you could have is somebody that reduces the premium payable on the acquisition of a lease and then instead increases the annual rent as a means of, well, getting around the Sdlt. So they have to assess the Sdlt on all the consideration involved, which is the premium and the net present value of the rent. Fortunately for those professional advisors among you that do deal with VAT on lease, with Sdlt on leases, HMRC have a useful calculator, so you can plug your figures in and it will calculate the Sdlt payable. Though it probably is worthwhile having some kind of professional assistance or review to make sure we're getting it right. But potential issues to think about when we're looking at calculating Sdlt on the rent, VAT on rent. Sdlt is assessed on the VAT inclusive cost. So if we've got VAT on rent, it's going to push up the Sdlt cost to the acquiring party. And it's also worth noting there that where the rent is, that calculation is based upon the rent payable within the first 5 years, albeit over the life of the lease, but the calculation itself just considers the first 5 years. And also it looks at the number of years that rent is payable for. That's how we calculate the rent. So issues can arise where either the rent is not confirmed or we don't have a confirmed period of the lease. Where the rent's unconfirmed, we often have to revert to utilising estimates of what the rent might be in order to calculate the Sdlt. But where the term of the lease is unknown, it's a bit more of an administrative issue. because what in effect we have is a growing lease. And so what we'd do is if we have a lease that has no confirmed period, we would do an Sdlt return based on a year's rent. And then we would have to revisit that computation again a year later if the lease is carrying on. So we'd have to revisit at the 2-year point, and then we'd have to revisit at the 3-year point. So there might not be a lot of Sdlt at stake, but the individual involved might, or the person, the party involved that's acquired the lease might end up having to incur quite a lot of professional fees to keep on revisiting that calculation of Sdlt. So it becomes an administrative burden. And so where possible, I think it's important to try and confirm the rent payable under the lease, and also to have a lease that is for a defined period, because it's going to make it a much more straightforward exercise for calculating stamp duty on tax. And just a couple of final points before we finish, a few miscellaneous points. We often come across VAT on commercial property. This is more of a VAT point, but has a knock-on effect for Sdlt. Properties that are opted to tax, they have to charge VAT on their supplies, their outputs, and they can also reclaim VAT on their inputs. But what that does mean, and what sometimes people aren't aware of when they opt to tax a property, is they have to charge VAT when they sell it or when they dispose of it. The issue, of course, being that stamp duty land tax is assessable on the VAT inclusive price. So that can push up the price quite materially. It might be the difference between a £500,000 property being sold for £600,000 because we have to add VAT, and the Sdlt would then be assessed on the £600,000 figure. It's probably worth noting that it is possible to transfer property and for the property itself to be outside the scope of VAT. That does need some thinking, and it does need some planning. But it's potentially worthwhile looking at, not only from a VAT point, but also because of the knock-on effect that it will have on stamp duty land tax, in that it will probably make it cheaper for the acquiring party. Yeah, something to keep an eye out for. And then the final point I've noted on there is a piece of anti-avoidance for residential properties. And it's where residential properties are over £500,000 are acquired by non-natural persons, which typically is going to be companies. Potentially the Sdlt payable can be 15%. Now, those of you that may have spotted that I've been talking about transferring residential properties into a company. There are exceptions for this piece of anti-avoidance where there's going to be a perfectly commercial reason for the properties being acquired, such as where those properties are going to be let out by the company, or where those properties are being acquired for development. Apologies, there's a typo there. And several other reasons. But if there's a commercial reason for the company acquiring the properties, then this piece of anti-avoidance isn't going to apply. The reason they brought it in is, I think, because there was a lot of rich individuals that were acquiring properties in companies, properties in London, let's say, very high value properties, just for the capital appreciation. So they're putting them in the company, and they were just to get that capital value, just to buy them up. But it just also meant that when they sold them, they wouldn't have to look at Sdlt. They would have to look at stamp duty on shares, which is 0.5%, so it's a lot cheaper. So it's this kind of things to discourage that kind of planning. But where we've got perfectly commercial reasons for acquiring the property in the company, then we're not looking at that 15% charge. So I think that about brings us up to time. I hope you found some useful things in our webinar from me and Laura. Every piece of advice is going to be different, so there's no one size fits all kind of advice that we can provide. So if you do have any clients and you're unsure about the Sdlt position, please do get in touch with myself or Laura. I'm sure we can probably assist you. Just a couple of notes there about our next seminars that are coming up. We've got one next month on staff benefits. So a useful one if you run your own company or if you deal with clients that have lots of employees. And then we've also got one in March on the taxation of crypto assets, which is becoming it's an emerging area for tax, and an area that often brings a lot of confusion. Yeah, I'm just going to pass over to my colleague Laura Brennan. She's had her eye on the chat box. So if there are any questions, Laura, please fire away. We've got about 3 or 4 minutes left before the webinar ends.
Yeah. So our first question is, what is a mixed use property?
Laura, do you want to take that one?
Yeah, sure. So a mixed-use property for SDLT is where there are some commercial elements to the property and there are some residential elements. And so typically you might see that where there's a shop and then above it there's a flat. So there are two different parts to it. So that's a good example of a mixed-use property for SDLT.
And if you have a mixed-use property, you'd have it would be the non-residential rates that would apply.
Yeah.
So I suppose potentially you could have a property with 5 or 6 dwellings, and provided there's a certain commercial aspect to it, let's say a small unit that's used for non-living purposes, you would have a much better SDLT result.
Great, thank you guys. And then we just have a second question. It is a little bit longer, so we might need to get back to them. But a married couple have PPR worth 500,000, and then they buy a second home for 200,000. They then sell the 500,000 and reclaim the extra SDLT. If they can buy another property for 450,000, would they have to pay extra SDLT on the 450,000, or can they repay the previous amount claimed back?
Okay, right. Well, first of all, let me try and get that straight in my mind. We've got a married couple, private residence worth 500k. They buy a second one for 200,000, so they would have paid the 3% surcharge on the second one, and then they sell the 500,000 one and reclaim the extra SDLT that they paid on the £200,000 property. So at this point, they only have one main residence. And then they buy another property. Would they have to pay the extra SDLT on the 450,000? The way that the rules work with this, and it might be worth us having perhaps a follow-up chat, is that the position is considered at the point in time that the properties are acquired. So if they have a second property, if they already have a property when they're acquiring the second one, we have to utilise the 3% surcharge rates. And then there is the option to claim back if we dispose of that additional property and then are left with just one main residence. So it's kind of something that you have to consider on a rolling basis. Normally a good idea to get the objectives, get the full story from the client before we advise them, because potentially on a timing point we might be able to get some SDLT back. But Heather, I'm more than happy to have a chat with you about that if you have some more, if you want to get a more in-depth answer, if you like, feel free to drop me an email or to give me a call. Yeah, the 3%, it can be a bit, it can sting a few people, especially if they've accidentally become property owners. Perhaps they've inherited a property or something like that, because oftentimes it means that they might go out and buy their first home, to live in, and suddenly find that they have to pay the surcharge because they become part owner in a property that they've inherited or been transferred from a family member. So we do see it coming up quite a lot, where people have just been stung really by the way that the rules apply. Quite an interesting area. I think that about brings us up to about 10 o'clock. So yeah, if there are any more queries, we will try and follow up with you afterwards. But alternatively, we are going to have a little breakout session now. So please do feel free to stick around. And if you've got any questions, me and Laura will be there for about 10 or 15 minutes where we can hopefully discuss your questions in more detail. So I'll just, if you hang on for a minute or so, I'll be able to disable all of your microphones, and then yeah, if you've got any questions, do feel free to fire away. We'll do our best to give you an answer. Okay. I think I've unmuted everybody. So I think I've allowed everybody to talk. So if you do have any questions, those of you that have decided to stay, do feel free to fire away. As I say, we'll do our best to kind of give you some helpful advice, and if not, maybe we could follow up after the webinar. Anybody have any questions?
Thank you so much. It was very interesting. I'm afraid I haven't got any questions, but it was very interesting. Thank you so much. Have a good day.
You're very welcome. Thank you very much, Rebecca.
Thanks, Ryan. Thanks, Laura. Take care. Bye.
Cheers.
Thank you.
Cheers. Take care. Bye-bye.
Bye.
I've got a question on the transfer of property into a limited company.
Yeah. Sorry, is that John?
Yes. Can you see me?
I can see your name. I can't see you. So you're okay if you're still in your pajamas.
Yeah, I've got a beanie on, and I was just like wondering what everyone could see. Anyway, the valuation at market value, does that need to be done by 3 independent valuers, or what would you propose there?
Yeah, well, we've got, so it just needs to be, it's not an area that we didn't deal with because obviously it's property, but where it just needs to be the market value of the properties involved. So presumably we would normally get a third party involved that is a specialist in valuing properties to get that figure, or the figure for each of the individual properties. But I think, as I mentioned, there's kind of 2 elements to that. There's the fact that it's for market value means that it doesn't really matter if there's any cash changing hands, but also, you know, you might have 10 properties worth £5 million. In effect, the SDLT calculation becomes a single calculation for one, as if it were one property for 5 million. So you end up having a very significant portion of the deemed consideration that's subject to quite aggressive rates of, not aggressive rates, but higher rates of SDLT. So it can end up being quite a large tax burden before the consideration of any relevant reliefs or allowances.
Okay.
Does that answer your question, John?
I guess, I mean, I can just see that the client will want to just get 3 different local agents to come around and tell him how much it will cost, and then go with that. Or does the law require it to be some sort of a proper valuation? No.
It just needs to be, based on the facts, it just needs to be the market value. So if those local agents have enough knowledge of the area and know what market values are in that area, if that's going to be the more cost-effective way forward for the client, especially, I imagine in many cases they have existing relationships with these individuals and businesses, then that should be fine. I think the point to make is just, you know, for people like us, you know, the accountants, tax advisors, solicitors involved, we probably don't have the knowledge to confirm the market values of property. So that's why they need to get that advice from elsewhere, really.
Yes. Yeah, not us. Yep.
Yeah. Not us. You don't want to put yourself on the line.
No.
Ryan, can I ask a question? It's a little bit out of the ballpark, but I just wondered, as we're doing tax returns now, we're finding clients who sold properties during the year, haven't told us, and haven't filed the CGT return that needs to be done. And it was 30 days, now it's 60 days. Just out of curiosity, in your opinion or your experience, should the solicitors be telling clients to do this? Because I was on a webinar ages ago with Rebecca Benningworth, and she was saying, is there a solicitor in the country who's not telling their clients to do this or not doing it for them? And I'm just like, have I got all the clients who've got the bum solicitor, or is it just sort of more nationwide than that? I mean, what's your experience, or do you not have any? I mean, just to sort of, you know, just to know what other people are finding with this.
I think probably the same as you, Rebecca. It's something that we considered actually quite a while ago when the non-resident CGT return came in. So that was about 2015, and that was the first time that individuals would have had to file something in addition to their normal tax return to report the disposal of the property. Now that regime was then extended to UK tax residents and to both commercial and residential property. And now we're in a position where we've got to file. It's a double whammy, really. We have to file that return within 60 days, and then we've also got to report the same gain on the tax return. So we thought about it at the time, and I think we probably sent out a lot of marketing materials to conveyancing solicitors to say, look, are you aware of this for your clients? Because the deadline is so short, because it's only that 30-day window. And to be quite honest, I didn't find much feedback really. And I think that my gut feeling is that conveyancing solicitors are probably so inundated with their own work that they just think, oh, that's the accountant's job, or either they're not aware of it, or they don't make their clients, or they don't make any effort to make their clients aware that there is tax to report on the disposal of, you know, the additional properties. So yeah, it doesn't surprise me that many clients get caught out and aren't aware.
Yeah, that's what we're finding.
I had one of those, Rebecca. The client comes to you after they've completed, and by that time it's already past the deadline.
Yes.
But it has been increased to 60 days, I think, in September or October last year. Obviously, 30 days was just not enough time for everyone. But it is weird that solicitors do take responsibility for the Sdlt, but then don't even mention the CGT.
Yeah.
Like, why not?
That's the thing. They don't even seem to mention it, John. You know, it's all very well saying 30 days or 60 days, but my clients will come to us when we're doing their tax return. You know, they could have sold this property a year or more ago. I mean, that's not the case. I mean, I haven't come across one yet, but they just don't think of. No one seems to have mentioned it to them, and unless they say to us they're selling a property, what, you know, we don't feel like writing to all our clients, say, have you sold your house this year? Or, you know, it's a very strange thing. You'd think a solicitor would tell them, wouldn't you?
You would hope, yeah. And I think more often we're dealing with filing that return late than we are filing it within the window.
Yeah.
For that very reason. Yeah. I think if I were I would hope if I were a solicitor, I would have it on my checklist of things to tell the client, every client that I'm speaking to.
Yeah,
even if it's just a case of saying, get in touch with your accountant as soon as to see if you need to pay any additional tax, you know, capital gains tax on this.
Absolutely. Oh, well, thank you very much for that. Thank you, John, for your input too. It's interesting, isn't it? It's not just, obviously not my bag of clients, it's everyone by the sounds of it. But thank you so much and have a good day. And well, I guess everyone's doing tax returns at the moment, so
so everybody's mad busy. But yeah, no, I think I hope you found it useful. I think particularly Laura's point about the relief for annexes is really is something to keep an eye out for, because we've managed to save very large amounts of stamp duty land tax, because there's this double whammy of being able to get the normal rates of Sdlt and multiple dwellings relief. So if you have somebody getting £1 million property, they're paying a pittance of Sdlt, and it's perfectly commercial, it's perfectly fine, it's just the way that the rules work.
Yes. We had that with a client in London who bought a house for 8 million, and there was a flat as well, which was part of the house. I mean, it was basically basement flat, nice property, obviously, and they paid 2 lots of stamp duty to begin with, and they were contacted by an agency who specialised in this and used them, which was fine, but they got a lot of money back, which was good. But it does seem to be something that no one's too aware of. Yeah,
and again, I think half the battle is really making people aware of either their tax issues or potential tax reliefs.
But I think that's why your webinars are so good, because, you know, as a small practitioner, I'm a sole trader. There are only 5 of us in the business, and I can't know everything, but it's knowing that there's something to know, if you see what I mean, and then knowing the right people to ask. So that was very, very interesting, and thank you. On a day when I was thinking I was just going to do tax returns, I nearly didn't come, and then it's been interesting and informative. So thank you so much.
That's fantastic. Thank you very much for your comments, Rebecca.
Thanks, Ryan. Thank you. Bye bye.
Yeah, if nobody else has any tax questions, we'll close down the Q&A session. But thanks for sticking around, guys. As I say, I hope you find it all very useful, and if you do have any Sdlt questions or issues going forward, please get in touch. Cheers.